What's up guys, my name is Nick and welcome to my channel. Today I'm breaking down the components of an options price and defining what we mean by intrinsic and extrinsic value. Before I share my screen and we head over to the whiteboard, don't forget to smash the like button and subscribe to the channel so you don't miss any future content. With that said, enjoy the video, and of course if you have any questions or feedback, be sure to drop them in the comments section below. I'll respond to them more personally. Cheers. Unlike stocks, options have an expiration date, and so because they have a finite lifespan, all else being equal, their value will decay over time. For this reason, an option's premium or price is composed of two distinct components: intrinsic value and time or extrinsic value. The intrinsic value of an option is the value that option would have right now if we're at expiration. Any remaining value in an option's premium that is not intrinsic is known as time or extrinsic value and is affected by factors such as the time until an option's expiration or an option's implied volatility. Let's break down these concepts with two very simple examples to highlight the difference. Let's first consider a call option. If we take a look at the bar chart on the right, notice it shows the absolute levels of premium for three different strike call options, the $99, $100 and $101 strikes. These options have 45 days to go until expiration. Notice the lower the option strike, the more valuable the call. Remember, a call option gives the buyer the right to buy the stock at the underlying strike price. Lower strike calls then are clearly more valuable than higher ones, all else being equal. Call options have intrinsic value when the current stock or asset price is trading above the option strike price. In this example then, the stock is assumed to be trading at exactly $100 per share. The 99 strike call, if it were to expire right now, would be worth exactly $1 since it allows the buyer of the call option to buy the stock $1 below the current asset price. This $1 of value is referred to as intrinsic value of the call option's premium. Notice, however, there is another component to the 99 strike call value highlighted here in blue. This is the extrinsic or time value of the option's premium. Note that all the value of the 100 and 101 strike calls are illustrated in blue. This is because the premium of both the 100 and 101 strike call is composed entirely of extrinsic or time value. Both these options would be worthless if they were to expire right now. How about put options? Again, if we take a look at the bar chart on the right, notice that this time the higher the option strike, the more valuable the put. Remember, a put option gives the buyer of the put the right to sell stock at the underlying strike price. Higher strikes are clearly more valuable than lower ones, all else being equal. Put options have intrinsic value when the current stock or asset price is trading below the option strike price. Again, the stock price is assumed to be exactly $100, and we can see the 101 strike put has $1 of intrinsic value, shown as the red portion of the total option premium. Each option has a blue element to its price, or an extrinsic or time value component. Note the value of the 199 strike puts are composed purely of extrinsic value. So what factors determine this extrinsic value? Well, options with a higher implied volatility have higher extrinsic value. Options that have more time to expiration also have a higher extrinsic value. This is because both these factors mean the underlying stock has a chance to move further, and so there's more chance the option can move in or out of the money before it expires. And the reverse is also true. Lower volatility and less time to expiration reduce the extrinsic value in an option's premium. So in summary then, an option's value or premium consists of two components known as intrinsic and extrinsic value. A call's intrinsic value is equal to the current asset price minus the call option's strike price. A put's intrinsic value is equal to the put strike price minus the current asset price. Extrinsic value decays as time passes. At expiration, an option's value is composed of only intrinsic value, and so an option may expire worthless. Options that have more time to expiration or have higher implied volatility will have more extrinsic value. If you're watching this, you made it to the end. Thanks for sticking around. I really appreciate your support. If you enjoyed the video, do me a huge favour. Smash the like button and subscribe to the channel. It helps me out a ton. Until the next one, guys, take care. Cheers.